So back on, beforehand we talked about the company issuing shares, company wanting to get in money, company wants to get equity. Now we're kind of talking about the other side, somebody who's deciding if they want to buy shares or not, or if they want to sell their existing shares. So we have to figure out somehow, how do we value shares? Is it worth to buy shares in that company at $3.48? Or maybe we should pay $5, or maybe I don't want to buy the shares at all because companies are going to go bust. We have to decide that somehow. And there's two basic approaches for these. I can tell you straight away, research is being kind of sus about both of them. One is technical analysis and the other one is fundamental analysis. And I think learning by doing here is again the way forward. So I want to do a tiny game quick. So we have here the Singapore Stock Exchange. It's currently running whilst we're having class. And currently the value here is 7.46, so that's 7,460, but let's just keep it 7.46. And let's just imagine I all gave you 100 Singapore dollars, and you can decide now if you want to buy into the Singapore Stock Exchange, so if you want to buy shares, or if you rather keep the cash in your hand and might buy shares in 5 minutes or so. So every 5 minutes we look at how the stock exchange is developing, and we are deciding if you want to buy shares or sell the shares. But you have to stick with the amount of money that you've got. And we're starting with $100. I play along too. So if you buy shares now, basically, so now the share price is 7.46. And this thing works much better if you write it on a piece of paper. Just write down buy or hold. One of the two things you have to do. So technical analysis, basically you're looking at the picture here and decide, well, maybe we're in an upwards trend, so I believe the shares price is going up. So you just make a line there and say, well, I predict it's going up. But of course, technical analysis could also be that somebody else says, well, if you look at it a little bit of longer time, if you connect these points, you will see it's going down. You can see already technical analysis is a little bit like astrology. So it's a lot of fluff there. And most research is not very supportive of technical analysis. So technical analysis is basically looking at past price development and uses that one to predict the future. The other way to think of share prices is fundamental analysis. So there basically you look at the company's books, financial accounts, you're checking out the management, you're looking at their prospectus, you're looking at all kinds of information that you find about the company and try to decide if their business is on their way up or if their business is on the way down and how much you would value that company. Just as I did beforehand in the class in the little video with Dropbox, where they're deciding, well, they've got this cloud strategy and they've got this million customers and they did this in the past, so how much should the company be worth? And you can see again, it's a bit fluffy, so clearly you're not coming up with a 100% accurate number, but possibly you come up with a better number than with the technical analysis because fundamental analysis is a little bit more forward-looking. You're looking into the future, maybe a little bit more than looking here into the past. Then there's other important numbers here. Price-earnings ratio. It has exclamation marks here because it's something important that you've heard once. It's lots of times in the news. In my personal opinion, it's not super useful. And if you look at research, it also says you can't do too much with that number, but it's one of those numbers that comes up in the news all the time. Hence, it's useful that you've heard it once at least. So what is the price-earnings ratio? Basically here we have the price, the share price, compared to the earnings per share of the stock and of that company. And then we decide, well, does that mean that the company is traded relatively cheap or relatively expensive? For example, if you have a price-earnings ratio that is very high, what does that mean? Are the shares expensive or cheap? Expensive, because it means that the share price is high, but they earn a little bit of money only. So that doesn't sound very good for you as an owner. But there are certain companies that have huge price-earnings ratios. For example, Amazon and Facebook, their price-earnings ratio would be very, very, very large. People still like these companies. And then there's other companies which have much, much lower price-earnings ratios. I could imagine, for example, the car producers, BMW, Mercedes, VW, but people still like to buy them. So in different industries have different kind of price-earnings ratios, and the information you get out of those, I personally think, is somewhat limited. Now, how can you use the price-earnings ratio to estimate future share prices? Well, you can say a company might have a certain price-earnings ratio and just pretend that these are stable. In the real world, they might change quite a bit, but if you're pretending they're stable, let's say 20, and if you're estimating that a company might do $5 of earnings per share in the future, then we can calculate what the future share price should be. 20 times 5, 100. But you can see already very big if. That only works if the price-earnings ratio is stable and if your prediction of the future earnings is correct. Both of them, huge question marks. So in this example here, we have current share price $7.50, earnings per share 50 cents. So this company has a price-earnings ratio of 15 times. 15 is a price-earnings ratio. And let's pretend you have some kind of insights, or you believe in the future this company will have 60 cents earnings per share. So you've heard somewhere that their profits are going to be good, there's new business, you believe the earnings per share are going up to 60 cents. Now, if the price-earnings ratio says 15, and it's really going to be 60 cents in the future, just using this equation here, we can calculate the future share price should be $9. But I reckon you could have done much quicker the same idea. Because currently, the earnings per share were 50 cents. 50 cents. And you believe the shares to go up next year and in the indefinite future to 60 cents. Now, just very quick in your head, by how much percent did the earnings increase? From 50 up to 60 is up by 20%. So if you believe that the company for the indefinite future makes 20% more profits, what would be a reasonable assumption should happen to their share price? If all their future profits go up by 20%, the share price as net present value of all future profits simply goes up by 20% too. And we can see that here too. Because 20% of 750 is $1.50, so 120% becomes $9. So it's really just what you believe will happen there. Right? So this is not science in that sense. We can't really predict the share prices. Good, before I go to Gordon's, remember what we had beforehand. So if you've written down if you bought the shares or if you sold them. I'm committing here I had hold, so I just kept the cash. And let's see, hopefully the share price changed already a little bit in the time. No, it's too soon. Didn't really change. 746 still. So again, you can decide now if you want to buy shares, if you had cash beforehand, or if you bought the shares last time, you can sell them. But basically, currently, we neither have plus nor minus. So everybody in the room still has $100 because the share price didn't change. So again, you can write down hold or sell or buy if you had the cash. I personally write down buy for me. Good. So beforehand, we had the price-earnings ratio, and we just looked at the earnings. There are some companies, they don't have any earnings right now, like Amazon, for example. They have lots of revenues, but they don't make any profits. But people believe, of course, in the future they will make a lot of profits, right? Amazon is coming to Australia. Amazon is getting more and more data. So lots of people believe Amazon will be hugely profitable sometime in the future. So the standard price-earnings ratio doesn't help. So what we can do with it one is we use the so-called Gordon's dividend growth model. Again, there's exclamation marks, meaning it's important. The basic idea here is the share price should be equal to the present value. As always, everything is worth its present value in economics to expected future payments. And in this case here, we let the future payments grow. So we believe that the future dividends will grow. Let's skip over this one. So what do we have here? We can use this formula here. D0 is just the dividends that have been paid out right now. Now, if this one is 0, then we are tough luck, because if 0 is growing, it doesn't matter at which rate, you still have 0. So you have to presume here some kind of positive number. 1 plus G, G is the growth rate. So that's in percentage how much you believe these dividends will grow. Divided by 1R, this is the required return. It's like a discount rate beforehand. So remember, required return for equity is not only the interest rate that you want to earn, but it's also the interest rate plus a risk premium, because shares are risky. Remember, we don't know if you get dividends or not. It's very risky. So this is basically a risk-adjusted discount rate minus the growth rate again. And that gives us the share price that we should be willing to pay right now. Now we have to estimate for this a lot of stuff. We don't know yet by how much the dividends of Amazon will grow over the next 20 years. Nobody knows, so we have to make a rough estimate. Also, we have to somehow figure out, well, what is a reasonable required rate of return? What is a reasonable discount rate here? The only things that we do know here is how much dividends they've paid up to now, or in last year. So let's see how we can get this one. The growth rate, we can either estimate or we can make it super plump and just say, well, they've grown in the past by a certain rate, and we presume they keep on growing like that in the future. Very dangerous. So these things that we're doing here are very simplified examples for this class, so that we can do some calculus in this class. I don't want you to put down your lifetime savings using these formulas here. Very dangerous. There's no guarantee whatsoever that the growth rate, past growth rates, will continue into the future. And that's the reason why we do the game with the Singapore Stock Exchange. We have here the dividend at a certain time n, dividend at time 1. Then n is the number of periods as well. Let's say this was within 9 years. The dividend grow from this number, 95 cents, to $1.45. Then we use this formula to calculate the annual growth rate, which would be 4.81%. So if you're growing 95 cents for 9 years continuously at 4.81%, we end up with $1.45. So this company, in the past 9 years, their dividends grew on average 4.81%. And we just believe that is a reasonable forecast for the future. Big question marks behind it, but that's our best guess. This company will grow at 4.81% in dividends. Now we have to figure out the required rate of return. How can we do this? For that one, we've got the so-called CAPM model. And students that have finance classes would have heard of these beforehand. That's a very famous model. We have this equation here. This equation will be on the formula sheet. All you need to do is to be able to use it. But I personally always find it frustrating if formulas fall out of the sky. And that's the reason I want to do a little bit of an X-course with you, that you get the basic idea of CAPM. X-course means not exam relevant. So if you really don't want to hear this stuff, you can switch off now for 3 minutes. But if you think, yes, I want to know what this stuff means here, that you can listen in. So the basic idea is the following. Beta is a measure of so-called systematic risk. Systematic risk is by how much something is being volatile together with the market, by how much a share is moving together with the market, or any kind of financial assets, how strongly is it linked to the market. Beta 1 means it's pretty much moving as strongly as the market. So if the market is going up by 10%, there's a good chance that the share is going up by 10% too. If the market is going down by 10%, there's a good chance this share is going down by 10% too. If beta would be 2, this share would be much more volatile than the market. And if beta is 0, it basically means it has nothing to do with the market. If the market is going up, that doesn't tell us anything where our share will go. They're pretty much unrelated. For example, if we have risk-free government bonds, they're not really related to which direction the share price is going. So we can write down here the risk-free rate at beta 0. Beta 1 is basically the market, and the market itself, so a market, I mean, for example, the ASX, has a certain kind of average return. We can write that down here. And now you can mix your own portfolio. You could have half of your money in the risk-free rate with government bonds and half of your money invested in the ASX. So if you spread your money 50-50, what's your expected return? Will your expected return be higher or lower than the risk-free rate? Higher. Will your expected return higher or lower than the market return? Lower. And by how much exactly? Let's say risk-free is 2% and the market return is 8%. You have 50-50 investment. How much will your average return be? 2 on one, 8 on the other. On average, 5. 8 plus 2 divided by 2 is 5 on average. 5 on average means that you're on the return side here in the middle. Now what happens to risk? If you have half of your money invested in beta 0, half of your money invested in beta 1, your portfolio most likely has what kind of beta? Will it be 0 or will it be 1 or something in between? In between. And since you have 50-50, 0.5 is the beta of your portfolio. So you can mix these two and sit then here. So you can have a portfolio of risk-free and ASX, financial assets, together, and it will earn you, in my number example, 5% with a beta of 0.5. And here comes the kicker. If there is another company out there that happens to have a beta of 0.5, what would be the required return for that company? If that company is earning 4% on average, is that good enough for investors? No, because at beta 0.5 risk, they can earn 5% with our mixed portfolio. Nobody's willing to buy a beta 0.5 company if they're only offering you 4%. The company needs to pay at least 5% like your mixed portfolio. The company needs to be at least on the level of this line here. Flip that around. Let's say the company is offering you a return of 6% with a beta of 0.5. So it's better than your mixed portfolio. Will lots of people want to invest in a company or few? So it's the same risk as your mixed portfolio, but a bigger return. Makes it very attractive. If a financial asset is very attractive, what happens to its price? Goes up. Lots of people buy the shares, share price starts rising. Once the share price starts rising, what happens to your percentage return? Similar to the bonds. If you have to pay more for the share, what's happening to your return on equity, to your value for money basically? Share price up, rate of return down. Same idea as with the bond. Because the profits, of course, don't increase just because more people buy the shares. The profits and the future profits are the same. So if the share price goes up, the percentage return goes down. And that happens, so people buy more and more of these shares until the expected return here is also 5%. So that means all shares in the market should be on this line. So the required rate of return should be somewhere on this line, because people can always compare it to their mixed portfolio. And that's basically where this equation comes from. This equation is the math behind this line. And this equation just says all shares are valued, or the required return of all shares is such that they are on this line, on the security market line. So that's very fast. Usually in corporate finance classes, I think you spend an hour on this. That's the reason why I said X course, right? Just to give you a little bit of a feeling where that equation is coming from. In this class, all that you need to be able to do is plonk in the numbers and calculate this here. Then I'm happy already, and you get the formula in the formula sheet. Yeah, so we need a risk-free rate, we need a beta of the company, we need the market return, and here the second time the risk-free rate. Do we have a number example? Yes, here. For example, ANZ, the risk-free rate is 3%. That's the treasury bill rate. So we plonk in 3% here, 3% here. Then what else do we need to know? We need to know the expected return of the market is 9.9%. So that's how much the ASX is most likely earning. But people believe 9.9. So we make the market return 9.9. And ANZ's beta in the past has been 0.9. So ANZ is going pretty much with the market. 0.9. We plonk in all the numbers and then we can calculate for ANZ we require return on equity of 9.21%. And that is the number we needed for the other equation from beforehand, for Gordon's growth model. That's our discount rate. Already adjusted for risk, for the beta risk. So we plonk in this number here, 9.21%, now in percentage. The old dividends had been 1.45. From the number example beforehand, we calculated a growth rate of 4.81%. Plonks in here, 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 here. And if you plonk in all these numbers, then we can calculate that company, in this example here was ANZ, the share price should be, according to our estimates, 34.54. That's the whole point of the Gordon's growth model. Because we expect ANZ share prices to rise at a certain rate. We expect ANZ to be a certain amount of riskiness, therefore we need a risk premium, or 9.21%, and we can calculate then the expected share price for us. And depending if the share price, actual share price is higher or lower, we're now having a buy or sell decision. Speaking of buy or sell decision, let's go back here very quickly to this one. Did it still not move? It's just not volatile enough today. Wasn't quick enough. So in between it went a little bit down, now it's back up, so there's still no movement. What a shame. So again, you make a quick decision, buy, hold, or sell, depending on what you had. So I'm just holding mine. So I'm still sitting at exactly 100. I imagine there's no changes here for anybody right now. It's not enough volatility. Very good. Back to this one, almost forgot. So what can I tell you? Make another audit. I can see that the golden coins are in fact $2 coins, and I can see at least 2 of them. So we've got two $2 coins, and what did I say? Several silver coins, quite a few of them in fact. So one last chance. Do you want to sell your share? $6. Anybody wants to buy it off him for $6? Nobody yet, so we're still sitting at a price of $6. Let me get the learning experience out of this one already. So nobody really knows how much it's worth apart from me. But we can see here the price changed from $5 to $6. So just the fact that information changes is changing the share price. So the share price is really driven by information that we've got in the market. And also, it's very hard for you to forecast what I will tell you in the next 5 minutes how much is in there. So forecasts, they can use as much science as they want. It's impossible to forecast the future, just as you might have hopefully noticed too with the Singapore Stock Exchange. In fact, there are quite a few studies out there that comparing active management, so experts in fund management that are deciding to pick stocks, and they are comparing them, the famous phrasing is, to monkeys throwing darts at share prices. Or instead of monkeys, if you don't have monkeys, you can also use basically random stock picking. And what studies show is that randomized stock picking is doing just as well as experts. Usually more than 50% of the experts are underperforming. And you had that in that reading too. Now, why do I say that one? Basically means that nobody can predict share prices. And even if they could predict share prices, you can't really make a profit out of it, of the following reason. Let's say, if I'm telling you there's exactly $10 in here, are you willing to sell it for under $10 to somebody else? Let's pretend for the time being. We're not actually doing this. Let's pretend there's really $10 in here. Are you willing to sell it for $9 to anybody else? No. If everybody in the room knows that Deutsche Bank shares are worth $100, is it possible to buy Deutsche Bank shares at $90 in the market? No. Share prices immediately jump to the information level that is in the market. So even if you know that a company gained in value, if everybody else knows that too, or if large institutional investors know that as well, you can't make a profit with that knowledge. You could make a profit only if you're pretty much the only one that has that information. Now, how likely is it that somebody in this class knows more about a share price of a certain company than anybody else? Not that likely, I imagine. How likely is it that an analyst at Deutsche Bank knows more about a share price than the analyst at Westpac, ANZ, Commonwealth Bank, and HSBC? Not that likely. And that's exactly the reason why lots of these active managers have trouble to outperform their benchmark. And on top of that, do they do it for free or are they very expensive? Very expensive. So their performance is mediocre, and on top of that, they get high fees. So for you as a customer, very tough. So always be careful if somebody has some kind of secret buying advice for shares. Very careful. I personally would be very careful with it at least.